Welcome to Witham Sounding Board, a podcast sharing powerful business tips, insights, and trends for those seeking to become a rock star in their industry.
Hello and welcome back to Witham's CFO podcast series. I am your host, Cuddy Thomas. I'm part of Witham's Oasis outsourced accounting and fractional CFO practice line. If you'd like to know more about what we do and how we support our clients, please go to www.witham.com/oasis, and that's spelled OASYS. Joining me today, Jim Kelleher. Jim was our first guest on our podcast series, and we're extremely grateful to have him back again. Jim has had an impressive 25-year career as a CFO across 4 different tech startups. He is an angel investor, and he does CFO consulting work with 7 startups. My discussion with Jim today will explore the CFO's role in managing through turbulent times and the impact of the current economic and political environment that is creating in companies of all sizes, and Jim's past experience on managing through similar times, and the CFO's role in helping companies get through those times. Jim, boss, welcome back. And thanks for spending some time with us.
Thank you very much, Cuddy. Happy to be back. I am happy to be back. Yeah, I think that the reason you guys have me back is because of these turbulent times, right? And because I'm so old, I've lived through some of these times. So I'm happy to share some thoughts on those turbulent times.
Well, it's also because you're awesome. And then you just kill these things just like that. So that's why we have you back. So you've seen various turbulent times, whether it was, the banking crisis of 2008 and 2009 or COVID in 2020. Why don't we start with, your current role as a CFO advisor and then an angel investor? What are you seeing in the economy as it relates to your companies and the actions they are taking?
Yeah, sure. And to set the scene, I'm mainly involved in the startup world, right? And so whether it's the one company I'm advising in Brooklyn, New York, is a 50-person company, and then my angel investments are small startups. And so I'll answer this from the perspective of them, but I think we're seeing it in general in the marketplace. I'd say the one word that I would use that people are doing is they're being very cautious. And they're unsure of what the short-term future is going to bring with regards to the business. So, the current, I'll say they're more that there's all sorts of political things going on too, but it's more the economic issues that are facing these companies that are causing that caution. It's not news to anybody that this administration, through its tariff program, has caused some consternation throughout the marketplace, and it presented those tariffs in a way that I think was not well received in the marketplace and just was not well thought out. And if you go back, this administration, I'm not talking political or Democratic at this point, but I'm just talking about the economy was in pretty good shape when this administration came in, right? The stock market was at an all-time high. GDP was growing at 2.5%. Interest rates were on their way down. Inflation was on its way down to 2%. And so you could say the ship was going in the right direction. The ship was sailing pretty good. And what they did with the tariffs was cause that whole thing to go get, pushed around and gone out to the air. And that's what's caused the consternation in companies right now, because they are unsure of not only people, my companies are not necessarily concerned with tariffs. I have a couple of like manufacturers that are involved. I have one that's actually a golf ball manufacturer, Irish company, believe it or not, that manufactures golf balls. Most golf balls are made in Taiwan or China. So they have some issues. And another one of my companies makes a small sports tech wearable that has some issues. But they're minor in comparison to, they're just afraid that if this economy goes into a recession, then everybody is going to pull back on everything, and that's what's causing the cautiousness right now. And you see it when I say cautious, people are cautious about hiring more. People are cautious about investing more dollars in new projects. And people are definitely cautious in the venture community or the private equity community about putting more dollars to play, right? And so getting money is not easy. So getting incremental funding is not easy right now, unless you're in AI. And if you're in AI, people are throwing money at you. But if you're not, they aren't. So, it was a long-winded answer to your question of how are companies acting or how are my companies acting. They're acting, cautiously in this market, and they're taking their time about spending decisions, and they're being thoughtful about what they're doing, much more thoughtful than they were 6 months or 8 months ago.
Yeah. Thanks, Jim, for your insight. Every now and again, there's a client that I had to log into their system with a VPN, and anytime consultants log me in. Right, just log me in. So that's the breach, that's the conduit to get into the system. So anytime that happens, like I say, I think Jim Kelly. Right. So log me in is a good example. I mean, you have to steady the ship during the banking crisis of 08 and 09. Tell me about that and how you got through it and successfully through those times, and then all the way to IPO in 2008, 2009.
Yes. Yeah, sure. So let me set the scene for people. So I was a CFO at LogMeIn, which was a Boston-based, I'll call it a remote access company or platform. The ability to connect to another device on the internet it's an interesting company because it was Hungarian with its technology and its formation, and came to the U.S. for distribution and for funding, and set up in Boston because it viewed Boston and the East Coast as the best spot to be. So it's a great Boston tech story. But we were, as Cuddy said, I started there in 2006. The business was $10 million, quadrupled that in a couple period of time. So in 2007, 2008, we were roughly a $50 million company. And we were right in the middle of this banking crisis. And when I say right in the middle, we were on file. We were on file to go IPO. The IPO market was really hot at that time in October of 2007. It was a hot market, even though we were a $50 million company with a doubling in revenue. So we had forward projections of $90 million, which in today's market, you could not get out. But in those days, you could get a company out like that. We were making money. We were in a hot market. We were growing the business at greater than 75% anyway on a top line perspective. So we were in a really good space. We filed in October of 2007 to IPO the company. We didn't file because we needed money. We filed mainly to create an economic event for our investors and for our employees. And what we felt was also a huge branding opportunity for LogMeIn, because as Cuddy alluded to, LogMeIn sold into either consumers or small to medium-sized businesses. And we felt that getting the cachet name out, LogMeIn, into the public market would actually help us from a marketing and brand perspective. And there's no question it did when we did do that in 2009. But we filed in 2007. October 2007, I still remember the day of myself and the CEO, Mike Simon, walking out of our banking meeting. And a banking meeting is when you decide your final bankers, right? So they all come and they pitch. And we were walking out of our final banking meeting just outside the New York Stock Exchange on Wall Street. And NASDAQ had hit an all-time high. And so we were like, this is beautiful, right? And best time to go do an IPO when the market's at an all-time high. 2 months later, that entire thing had been, turned upside down. The mortgage banking crisis happened. We, in fact, had selected Lehman as our lead banker. As many of you know, Lehman was one of the victims in that banking crisis and ended up going out of business. So we went from a place of being ready to IPO to having the entire market be frozen on us and no idea when we'd be able to get out. That was in a 2-month period of time. So in December of 2007, that would have been, is when that really started to take fold. I think Lehman failed in January of that year. All of a sudden, we were in this, you could call it turbulent time, right? And the whole market was. It had been something that was unprecedented, that had never happened with this banking crisis. And the government did a lot of good things to fix it and took some immediate action. We sort of took a step back and said, okay, we're not going to be able to get public. What do we want to do? We had a business model that was working. We had a business that we thought was still going to keep growing. We were a little bit unsure of what the market would bring, given the economic uncertainty, just a little bit like today. So we sort of pulled back a little bit on our spend, but we, in essence, concluded we're just going to keep doing what we're doing, because what we're doing is fine, and we're building a business, and we're making money, and we're making cash, and we don't need the funding. And when the markets open up, we'll be ready. And so we did a whole bunch of smart things in that period of time, both with ourselves internally and with our advisors, particularly our legal firm at the time, WilmerHale. We so-called stayed ready. And so we were ready to go to the public markets. We kept all our filings current through an 18-month period of time. We kept closing the books like we normally would. We kept doing our quarterly audits like we would. We acted like a public company in that time, even though we weren't. And then eventually what happened was, look, the market opened up. And when the market opened up, we were ready to go. And there was a company called Open Table, who's still around. They've been acquired by somebody else. Open Table got out. A company called Solar Winds got out. A company here in Boston got out called A123, which is in the battery market. And after those three got out, we said, okay, we can do it. And our bankers felt we could get to the market. And so we went from kind of 0 point of scratch to being meeting with the bankers, the sales staff in a 4-week period of time and being on the road. And so we're really smart to have stayed ready because the window did not open for that long a period of time. And we were able to get out in July of 2009 and a very, very successful IPO. It was 30 times oversubscribed. We had 90% of our people that we met with one-on-one bought the stock. We priced the stock at 16. It opened at 20. Between 18 and 24 months later, it was trading in the 40s. So, our employees made money. Certainly our venture people made money, and our angel investors, and even our public investors that came in the early going. So it was a very, very successful offering and subsequent run in the public markets for us.
Impressive. And I think one of the things that I'm just going to highlight is you mentioning that you were operating as a public company, even though you were not public yet. That's important. So it's for people to know you have to be able to do that and not wait until you get to IPO.
Yeah, I've always, and I've always, to expand on that a little bit, Cuddy, I have always believed, and it was, that even in your smallest state, you should operate like a public company for financial purposes. Doesn't mean you have a whole bunch of, regulations and bullshit around it, but that you close your books timely, you have budgets, you do budget versus actuals, you understand those things, because, one of three things are going to happen to you as a private company. You're going to be able to get public, which is very, very rare, right? It's less than 1% of all companies ever do it. You're going to get acquired by a company, and typically that is going to be a public company, and they're going to want to look for that, and that's going to help you get it quite easy. Or you're going to go out of business, right? And so you really don't want to plan to go out of business, so you really want to plan on either one or two, right? And more likely you're going to be acquired by somebody. So people really appreciate that. We did it. We did it at IamLogic. We did it at Actifio, where we were too, right? We operated like a public company, and we tried to put the procedures, the controls in place that allowed us to, look like that to somebody who would come in and, kick the tires on us.
Very good. Drift was another successful CFO role and exit. Can you tell us about that experience and the actions you took to get Drift through that turbulent times?
Yeah, and Drift, for those of you who don't know Drift was in what we would call the conversational marketing. It was the conversational marketing platform. We sold in the B2B, and it allowed people to come to your website and be engaged by an intelligent chatbot that would push you further through the sales process. Now that is much further now with ChatGPT and all sorts of things like that. But Drift was one of the first intelligent chatbots, actually, and was on the cusp of that, AI industry. We were one of the fastest growing companies in Boston. I joined in 2018, where we were 50 employees. We had just closed $3 million of ARR. 2 years later, we were 250, 300 employees, and we were doing $50 million in ARR. So the growth path in that first period of time was tremendous. And Drift's turbulent time was COVID, which I'm sure all of us remember, right? And in a weekend, or in a week anyway, businesses shut down. And that's what happened in the so-called Drift turbulent time. We were not in a public offering process, but we were trying to run a business during that period of time. And unlike LogMeIn, Drift was focused on really growing that top line. So we were investing a lot of money, and our investors' money, into the sales and marketing to grow that revenue. And we had done that and grown it tremendously and gotten really good valuations as a result. But as a result, we were burning cash. And so we came into a different scenario than what LogMeIn came into, right? LogMeIn was in a spot where, okay, if I can't get public, that's fine. I'm just going to run this business. and we're going to continue to make money. Drift was in the mode of, I can't continue to run this business the way I'm running it because I'm going to run out of cash, and I'm not sure I'm going to be able to get more cash in this marketplace. So at Drift, we had to be, I wouldn't call it more dramatic, but we definitely, we had a business model that was continuing to accelerate. We took a step back, and it was probably March 12th or March 13th when we decided, when COVID shut down a lot of stuff and we were going fully remote, we closed we had roughly 50, 75 open recs. We closed all our open recs at that time. We redid our model to relook at our marketing spend. We pulled back on discretionary spend, some of which was easy to pull back on because people weren't going to be doing traveling and people weren't going to be going to conferences and stuff like that. So some of that stuff was easy to pull back on, but some of it was not. And we did that all under the auspices of Drift itself. We felt that the product we had was actually going to play into the marketplace a little bit, because what Drift was about was not having to engage personally with somebody in a meeting, but having to do it via the web, via a chatbot or via a chat. And so we felt to a certain extent, hey, businesses are going to redirect some of their marketing spend to tools like Drift, but we were unsure of that. Now, in fact, that did happen. We were impacted by the fact that people pulled spending back in general, but people did gravitate to the platform. So it didn't hurt our business that much. But what we were focused on, and our fund is, just like the two LogMeIn founders were focused on, hey, let's build a profitable business, and they did that from day one. Our two founders were focused on, David Cancel and Elias Torres, they were focused on building a culture and building an employee base. And we had done a really nice job of that. And so their mode was, hey, let's go protect the employee base and protect what we have. And we think if we can do that, we will come through this on the other side and we'll be in better shape. So we did everything possible to not have layoffs, despite the fact that lots of Boston companies overnight laid off people. Toast in here laid off 40% of its workforce in a week, right? Our employees were afraid we were going to do that. But what we did was, because our model, we had flexibility in our model, we were able to pull back the spending, pull back the headcount, and protect the employee base. And that's what we did. We did not lose, we did not do one layoff during that period of time. And we were able to push through that period by redoing our model, looking at our spend. We did some smart stuff finance-wise. We actually went and got some of the government PPE money that was going on at the time. In the end, we didn't take it because our venture people in the end put up the money that the government was going to give us, because they didn't think we should be taking the government money, even though it would have been entirely legal and was possible. We also had put in place a line of credit with Silicon Valley Bank. We had done that like 6 months earlier, and we immediately pulled all that cash so that we put that cash in our bank account. And so we done some stuff to solidify the balance sheet. We did some stuff to solidify the model. And we were able to push through that period of time. We didn't have a successful outcome as LogMeIn, that we didn't get the public markets, but economically, we sold that company in 2022. We sold Drift into a private equity investor at, unicorn company at greater than $1 billion at the peak of the market in October of 2022 at 15 to 17 times ARR. So it was a very, very good deal. And just like we protected our employees during that COVID period, we put $300 million of, you can call it cash or return, back into our employee base. At that time, it was roughly 600 employees, but $300 million of the acquisition price went back to the employees because they were all shareholders in it, right? So it was a great economic event for employees as well as for the investors when we did the transaction a couple of years after COVID.
Yeah, this is another great story. And, COVID was something of a thing that sort of allow people, C-suite to showcase how nimble they could be. And a lot of the smart companies back then were real smart, and some of them were not, right? But when you look at both of these really amazing stories, right? Talk about how you as a CFO helped the company or management team through those times.
Yeah, I think the biggest thing that the CFO can bring, and that I brought to both of those environments, and in Drift I needed a little bit more than in LogMeIn, was I would call it like a sense of calm, Cuddy. We did not panic in either of those two things. Yeah, we had the foresight to say, okay, like, fine, we understand the facts. let's figure out how we deal with facts and figure out our options. Where I think some people in both cases like panicked in those environments, that they act before they think. And we were very much in, let's think about it, right?
Right.
And I think the CFO needs to bring that, right? Because the functional capability of the CFO is around that, right? It's the idea of being able to have that foresight and being able to say, okay, let's just look at the facts, as opposed to founders can get emotionally involved and sales executives can get emotionally involved in things more so than I think finance people in general. And so that's the biggest thing I think we did, that we were calm, we had a thoughtful process, and we went through that process to figure out our options. Now, in both cases, we had business models that we could quickly adapt, which we did. We had KPIs that would predict the future in both cases that we immediately put a little bit more focus on, whether that's sales productivity or pipeline productivity or time to close deals and stuff. But we immediately said, okay, we're gonna pay more attention to these things. And we had options, like I explained at Logman, we were cash flow positive, so that was the option that we put ourselves back on. At Drift, we pulled on this debt line that we had set up previously that really helped us get through it. And so even some of the venture investors said to me it was amazing. And I didn't have foresight that COVID was coming. I just had foresight that we wanted to protect the balance sheet, but that we were able to get that debt and be ready to pull on it. Because, on March 13th, if we had went to Silicon Valley Bank and said, hey, we want a $30 million debt line, they would have said, sorry, not here, right? 6 months earlier, it was fine for us, right? So we had put some stuff in. So I think those were the things that we did really well. And the other thing that, and I don't know if it's as much the CFO or my personality, is like, I always wanted to be positive, right? So people can always, the glass is either half full or half empty, right? I'm always, it's a half full glass, right? And so I was always positive on there have been worse things that happened in the world, whether it was 9/11 or other times. And the markets have pushed through it. People have pushed through it. Companies have pushed through it. So we will get through this stuff, just like if this economy goes into a recession, right? How long it goes in, who knows? But it, it'll come out if it does go in, right? And you just got to be ready for okay, we're going to enter this thing. We're going to get out of this thing at a certain point, and I just want to be ready when I get out of it. But you have to have that positive attitude of we're going to get out of it. And it was important at both places. Log Me In, we had, because we were so close on IPO, when I say people, the employees, they had already anticipated their bank accounts going up by so much money as a result of us going through an IPO, right? And so there was already this expectation of, well, okay, I've been working at this 4 years, now I'm going to make a lot of money. When we had to pull back, we had to reset those expectations. And
right.
You can't be in the mode of, well, no, I'm not sure when we're ever going to get out, right? But you can be in the mode of, look, if we just keep doing the right things, we will get this company into the public markets at some point, right? And so you just need to stick with us, right? And that's what we did. And we didn't lose employees, and employees stuck with us, and it was great. Drift was the same way. Look, we're not going to lay off people, but we need you to stick with us, and we need you to, when you go remote, we have to look like we're in the office, and we got to be working hard, right? And we had that. Our productivity actually increased, when we went in some of the stats that we were reviewing. And so we had that buy-in from the employee base, and I think we had that buy-in because of the positiveness that we as a company projected into those environments.
So I have 3 or 4 words that I sort of gleaned from what you've said in the last 25, 30 minutes is set the right expectations, be ready, and be positive, right?
Yep.
I think if you have those 3, and then you could definitely navigate through any turbulent times.
On the be positive note, it was, you have to also have some, even though times are difficult, you have to have some fun at what you're doing in difficult times. So, when we had the Drift meeting, I remember I had to do a part of the presentation on what we were doing in the financial model and how we were going to get through it. But I started that presentation with a quote and I had gotten it from Jamie Dimon, had done a company-wide JP Morgan meeting a week earlier or something, and he had some general from the United States Army speak. And the general started with the comment of, look, if for those of you who are new to the workforce, and if this is your first crisis, welcome to the show, right? And because, in your lifetime, you're going to go through 4 or 5 of these crises, right? And anybody listening here, if this is your first one or your second one, you probably got a few more to come. And people really appreciated that afterwards from Drift, where people came up to me and they were like, we were so afraid and stuff. And the CFO gets on and he says hey, welcome to the show, right? And so people took that you could say a bit of humor or sarcasm and stuff, and said, all right, let's go, let's get through this thing, right? So I think you have to have that to get through, no matter what it is in your personal life or your professional life. You have to have that sort of an attitude to get through things.
Very good. Great advice. Any final thoughts before we sign off?
No, I think we covered the things of like you said, be ready, have a flexible business model, be positive about it. The only other thing that I would say is the CFO is also looked at as the person usually that brings, I'll call it calm to any situation. And so the whole idea of, even if you have a lot of angst about what might happen, understand that you're communicating to an employee base that doesn't have as much knowledge as you and is probably more emotional than you around it. So I think if you can exude calmness, then that calmness, that Navy SEALs have a saying where calm is contagious, and I think it's true, right? And so if the leader is calm, that calm can go throughout the workforce. So I think that's the final thing of I'd be important about that and making sure you're thoughtful and calm about the approach you're taking in any type of, urgency or turbulent times might happen.
Very good. Very good. Thanks, Jim.
Pleasure.
Well, we'll touch on, the turbulent time, what's the current economic and political environment, and real life example with LogMeIn and Drift. And by the way, anytime I log into a VPN and I see LogMeIn, it's like, that's Jim K right there. So if you'd like to know about what we do and how we support our clients, please go to www.withim.com/oasis, and that's OASYS. Thanks again, Jim. We'll talk to you soon.
Be well, Cup.
Thanks for joining us. Be sure to subscribe to our podcast so you'll be first in line to hear what's coming next. Don't want to wait for our next episode? Check us out at withim.com. That's WITHUM.com.